Looks like we have everyone. I'm going to go ahead and call to order the Retirement System Board of Trustee meeting Friday, March 19th, 2021, called to order at 8:01 a.m. We'll begin with the roll call. We'll start with myself, Lee Colick, Chair, calling in from Royal Oak. Next, we have Brett Nelson, the Vice Chair.
Present from Troy, Michigan.
Thank you. Kyle DeBuck, Commissioner, serving as trustee on the board.
Here in Royal Oak.
Thank you. Monica Hunt, Commissioner, serving as trustee on the board.
Present in Royal Oak.
Thank you. And Paul Brake, City Manager, serving as trustee on the board.
Present in Royal Oak.
Thank you. Also attending, we have Julie Rudd, Board Chief Administrative Officer, Board Secretary, Board Treasurer.
Present.
Thank you. Lisa Genord, Financial Analyst, Pension Technician.
Present.
Thank you. Tom Michaud, Board Attorney.
Here.
Thank you. And Terry Gerlich, Investment Advisor.
Present. Here.
Thank you. That will bring us to public comment. Carol, did we have any public comment?
You have nobody in the audience today, so no public comment.
Perfect, thank you. I'm going to go ahead and make a motion requesting that the board approve the agenda for March 19th, 2021.
Support.
I have support by Brett. All in favor? I am a yes. Brett?
Yes.
Kyle?
Yes.
Paul?
Yes.
Monica?
Yes.
The motion carries. Thank you. I'm going to make a motion requesting that the board approve the minutes for February 19th, 2021. Is there support?
Brett supports.
Support by Brett. All in favor? I am a yes. Brett?
Yes.
Kyle?
Yes.
Paul?
Yes.
Monica?
Yes.
Thank you. Next is that request that the board consider for approval the following adjustments, applications, and benefits. Trevor Tanner, former officer with the police department, requests withdrawal of employee non-vested contributions and interest from the plan amounting to $877.19. Separation from service was effective January 12th, 2021. Applications. Catherine M. Shidlowski of the Police Department, ROPOA Bargaining Unit, 26 years and 8 months of service credit, requests retirement date of March 26th, 2021. Eligible based on years of service and age. Catherine M. Shidlowski requests an estimated pension payment in accordance with the following policy. Effective January 1st, 2020, the board will allow for payment of an estimated pension payment for certain new retirees that make the election due to hardship. The estimated calculation will be calculated by taking 75% of the straight line calculation using average base wage only. Base wage that will be utilized in the FAC excludes roll-ins, years of service, and the applicable multipliers. Any under/overpayments will be paid/collected. This policy will be available to those employees with a retirement date of January 1st, 2020 through August 31st, 2020. At the July 10th, 2020 retirement board meeting, Lee Colick motioned to continue paying estimated pensions or estimated payments from January 1st through August 31st each year, as long as the criteria is met by the applicant. The motion was adopted unanimously. I'm going to make a motion to approve the adjustments in applications as I just read. Is there support?
Brett supports.
I have support by Brett. Thank you. All in favor? I am a yes. Brett? Brett?
Yes.
Thank you. Kyle?
Yes.
Thank you. Paul?
Yes.
Monica?
Yes.
The motion carries. That brings us to investments. I'm going to go ahead and turn it over to Terry.
Hey, thank you, Mr. Chairman. Good morning, everybody. Why don't we jump right in here? Hopefully, let me, before I do that, make sure I'm sharing my screen properly. Can everybody see that?
go. Got it.
Got it? Okay, great. Okay. Well, February was a good month for the portfolio. As you might recall, January was pretty flat in the markets after the big run we had in the fourth quarter. But the markets continued to power their way higher in February. The one thing that is different now so far this year is what we previously discussed, which is that the outlook for bonds has changed significantly. We are starting to see interest rates move up fairly substantially here, at least in the longer treasuries. The Fed, of course, controls short-term rates. They're committed to keeping rates near zero at the short end to help accelerate the recovery. But the market investors have become much more concerned about possible inflationary pressures. I know that's a theme that we sort of introduced at the last meeting, and it seems to be the number one topic, and will probably continue to be the number one topic on investors' minds as we go through the year. So you see, for example, investment grade bonds, very different return pattern than what we've seen over the last several years, now actually losing money slightly as interest rates are increasing. So the bond market is a very different environment than what we've been used to seeing. We think that pressure will continue, at least here in the short term. Investors, particularly after the passage of the latest stimulus bill, 1.9 trillion, most forecasts are now looking for GDP growth in the U.S. of north of 6% this year. So a little more concern about the possible direction of inflation. But as you can see, equities continue to move their way higher. Commodities also bounced strongly again on really the same theme of reaccelerating an economy and demand and possible inflationary pressure. If go to just where the portfolio stands as of the end of February. As you see we've got the target allocations versus the actual allocations, and things are pretty much in line with targets, well diversified within the asset classes by strategy. Of course, note that the target for private equity, or what you see there listed as GPA 5 towards the bottom, is 5%. It's going to take years to get there, but that's a program that we are building and will continue to build. Next slide here, if we start at the bottom of this page, you can see for the month started with about $173.9 million. Just under $1.7 million in cash flows out of the portfolio to pay benefits, but we had a gain of $2.8 million for the month. So the portfolio value has increased slightly to just over $175 million. And you can see on a year-to-date basis, there was really the 2 months there. The gains so far are just slightly exceeding the benefits being paid out. So the value is relatively flat at the $175 million level. Moving to the top portion of the slide, as you can see for the month, you see that positive performance there of 1.6 or just under 1.6 on a net basis versus the portfolio index of about 1.2. So year to date, after a flat January, portfolio up about 1.7%. Off to a good start. Good to see continued positive moves in total value, and in general, the managers are doing a pretty good job here and are ahead of their benchmark so far this year. Of course, that's a very short period of time. I wouldn't judge relative performance based on 2 months by any means, but off to a good start, which we obviously like to see. And of course, you got the longer compounded returns as you look out at 1, 3, and 5 year and inception compounded annual returns versus versus the benchmark. We break down that 1.63% for the month. On the next page, you can see where those returns came from. And as you can see, as you know, we're passively implemented in U.S. equities and active management in the remainder of the portfolio. And you see equities led the way, up about 2.8% for the month. But again, I point out the different tone in the fixed income market. Look at the next green line down towards the middle. Fixed income down 1.7% for the month as a result of rising rates. Rising rates hurt both the U.S. investment grade market as well as emerging market debt. Rates rose around the world. Offsetting that somewhat, of course, was high yield, which was positive as investors continued to gain confidence in the economic recovery that pushed these more credit sensitive areas of the fixed income market higher, as you can see. So that helped to mitigate some of the downturn we saw in the more interest rate sensitive sectors. Overall, nothing to really call out here in terms of performance, either on a 1 month or a year-to-date basis. Managers, as you can see, are generally doing a good job, pretty much in line with our expectations, either slightly behind or ahead of the benchmark so far this year. So no real outliers one way or another. Things look pretty solid to start the year. I'd also point out structured credit here, that again, very credit sensitive, more volatile area of the fixed income market, more illiquid trading, if you will, tends to move around a lot as sentiment moves around on the part of investors, and that positive sentiment is certainly helping. So we've got a very strong 6.5% for the month. And I know that this is a relatively recent investment. I know when we started about a year ago, we actually started in the negatives. As things fell apart in the economy early in 2020, we've recouped those losses. And as you can see, since inception, which is really, don't go by the top line there, which is 2014, that's the inception of the whole portfolio. The inception for the structured credit fund is about a little over a year ago, now up compounding at 7.3%. So good to see that come back as we were hoping to see. It's really played out. It's played out well so far. Nothing to report on private equity really. That's posted only once a quarter, so it shows zero. Just a placeholder there. So no new news there. But expect to see a positive return from that asset class as well when that gets posted for the quarter. And then core property. There we go. I'm sorry. Core property, the same, just up above. The same story there that is posted once a quarter. So that's just a placeholder there as well. So hopefully we'll see when you aggregate it all. I'll go back to the prior page. That 1.63, I would expect that the actual return is a little bit higher once we post those quarterly returns. So that's the report. Nothing really extraordinary to point out. Things seem to be unfolding the way we discussed earlier in the year in the marketplace. Questions?
Does anyone have any questions for Terry? All right, I'm going to go ahead and thank you, Terry. I'm going to make a motion to receive and file. Is there support?
Brett supports.
A support by Brett. I am a yes. Brett?
Yes.
Kyle?
Yes.
Paul?
Yes.
And Monica?
Yes.
Thank you. The motion carries. Brings us to legal.
Thank you, Mr. Chairman. Recommendation would be to approve the 4 items listed as a receive and file under legal, please.
I'm going to go ahead and make that motion to receive and file. Is there support?
Brett supports.
Brett supports. All in favor? I am a yes. Brett,
Yes.
Kyle,
Yes.
Paul,
Yes.
and Monica.
Yes.
Motion carries. That brings us to other. I first of all just wanted to make mention, I'm not sure if it would be Julie or Lisa, but I really appreciate the summary in the minutes in relation to the benchmark. I thought that was nice to see. So thank you to whoever took the time to do that. I'll turn it over to you, Julie.
Thank you. So we're going to skip the first item under other for now, correct?
Yes.
Okay, so the next item is just informational. The police and fire trustee position is up for election this spring, and a flyer is going to be distributed April 9th to the police and fire buildings. And also, we're going to try to put a notice on the NODs for that payroll. So we're not sure. We only have a certain amount of characters, but hopefully we're going to be able to get that out to the member population. So that was it. Just wanted to let everyone know.
Okay. Sounds good. Thank you.
You're welcome.
All right, let's go ahead and set the date for the next meeting. Does Friday, April 16th at 8 a.m. not work for anyone? Okay, looks like it's good with everyone then. I'm going to go ahead and set the date of the next meeting for Friday, April 16th, 2021, 8 a.m. I'm going to go ahead and make a motion to adjourn.
Brett supports.
Support by Brett. Thank you. All in favor? I am a yes. Brett,
Yes.
Kyle,
Yes.
Paul,
Yes.
and Monica.
Yes.
Thank you. Meeting is adjourned at 8:18 a.m.
Thank you all. Stay safe and look forward to seeing you hopefully in the near future.
Thank you as well, Terry.
Brian, I'll send you a text when you come back in.
Okay, I was gonna ask, you want me to, I'll drop.
All right. Thanks, Brian. All right, I'm going to go ahead and call to order the Retiree Healthcare Investment Board meeting for Friday, March 19th, 2021. Call to order at 8:19 a.m. Begin with a roll call. Myself, Lee Colick, chairperson, calling in from Royal Oak, Michigan. We have Brett Nelson.
President
who
calling.
is- Thank you. Kyle DeBuck, commissioner, serving as trustee.
I'm here in Royal Oak.
Thank you. Monica Hunt, commissioner, serving as trustee.
Present in Royal Oak.
Thank you. And Paul Brake, city manager, serving as trustee.
Present here in Royal Oak.
Thank you. We also have Julie Rudd, finance director, serving as board chief administrative officer, board secretary, and board treasurer.
Present.
Thank you. Lisa Genord, financial analyst, pension technician.
Present.
Thank you. And Tom Michow, board attorney.
Present.
Thank you. Brian Green, investment advisor, has stepped out of the room and will be joining the meeting shortly. We have no public comment. I'm going to move to make a motion that the board approve the agenda for today's meeting with the only slight adjustment that we're going to make is that we're going to move discussion under other up to the first line item. Other than that, I'm going to make a motion to approve the agenda. Is there support?
Brett supports.
Thank you. All in favor? I am a yes. Brett,
Yes.
Kyle,
Yes.
Paul,
Yes.
and Monica.
Yes.
Thank you. I'm going to make a motion to approve the minutes for February 19th, 2021. Is there support?
Brett supports.
Support by Brett. Thank you. All in favor? I am a yes. Brett,
Yes.
Kyle,
Yes.
Paul,
Yes.
and Monica.
Yes.
All right, thank you. So now we're going to talk about the annual advisor and consultant review. In accordance with the board policy, each year the board review one existing advisor / consultant with prospective advisor / consultants. The next consultant for review is the investment advisor. So we are going to be discussing both boards, pension board and healthcare. I guess we can look at them individually rather than comparing them directly with one another would be a good way to start it. So to start with, Terry's group. I've been happy with him. He's stood the test of time. He in my mind has shown us time and time again that his performance speaks for itself. Is anything else that they would like to discuss regarding Terry or yes, Paul?
Lee, what is the term of the agreement? Is this something that we do annually, or are they on a set contract?
Mr. Chairman, if I may, all these relationships are on a termination at will basis. So I think the expectation is that you can make a change anytime you'd like, but you review them on I'll say it every 4 or 5 year cycle, unless you feel the need to review them immediately. So this is all part of the due diligence process, that at least you have a discussion with all your providers, at least on some level of review. And so they're not locked in for any long period of time, but you are reviewing them periodically.
Okay. So, and my only other question, and this would be geared towards or directed to Julie, is there, from the finance department perspective, do we review the fees that they charge and do our due diligence?
Julie, you're muted if you're speaking.
And I can speak to her offline about that, so it's not critical. I agree with you. I'm fine with the investment advice that he gives us, and it seems very prudent in keeping the portfolio that balanced in terms of stocks versus income sort of arrangements. So,
Okay, thank you. We had, just for the historical significance, when we first established the healthcare board, there was discussion of having the same advisor for both boards. It was a preference that was voiced. I think it was the previous city manager who had pushed pretty hard for two different advisors for the sake of being able to look at the performance of one versus the other. So I just did want to throw that out there. There's an option to have both boards by the same or both by different. So Julie, were you able to hear the question that Paul had asked regarding if the fee
Yeah, sorry, I couldn't get to my Zoom.
No problem.
Up. We do look at invoices each quarter when they come in. We compare the market value that they charge their fees upon, and also the rate. So prior to paying those invoices.
Okay. Does that answer your question, Paul?
Yes, it does. Thank you.
Okay. Thank you. Did anyone else have anything that they wanted to add? Any concerns? Personally, I'm not ready to make a decision on anything today. I did want to have a discussion, and then, if we can table making it. Sorry, go ahead, Kyle.
Do we have like a year-over-year comparison of performance against market, and can we compare to performance against other managers? How do we benchmark performance?
Julie, can you speak to that, please?
Yeah, that's what actually I was digging for that. Yeah, each advisor has their monthly, quarterly, year-to-date, annual, and then since inception, performance relative to the benchmark. Also, net of fees. So you'll see that both for SCI and ANCO. So in their report, in this particular one, I can send you the page number if you want in the email for this.
Yeah, thanks. I'm digging for like an at-a-glance comparison just to see if I have any further questions about that.
Could you send that to the whole board, please, Julie?
Yes.
Okay, great. And then is everyone on board with just tabling this decision, getting more information, and then having a follow-up discussion at a future meeting?
Yeah, Brett's good. I mean, that answers the question about Kyle's question about their performance relative to the benchmark. But the only outstanding question would be their performance relative to other managers. How do we go about soliciting that information? I mean, you'd have to, I guess, to some degree, right, get up managing the money in a similar fashion to the investment strategy we're using. Is that an impossible question to answer, or is there a way to?
If I may, Mr. Chairman.
Absolutely.
It is a difficult apples to apples comparison, because if you look at the investment consultant that has two different clients, there might be a different preference for, asset allocation and risk. And so you really can't compare those two clients, as the same portfolio. But what you do, the nice thing about this structure that you have right now is that you are comparing both, investment consultants against each other. So you have an internal comparison, which is better than most. And then really you do look at the benchmark returns, and that if the managers that the consultant is bringing to you or selecting for you, if those managers are underperforming their asset class benchmark, well, that's not a positive for the investment consultant. So you really are looking at, the total portfolio benchmark versus your actual returns, and to see, how the investment consultant is performing. There is not a meaningful benchmark for investment consultant performance. You're really looking at their underlying managers to see how the managers are performing, and their success is being dictated by the manager's success. And it's, so there is not a bright line. There's not a bright line test to apply.
Gotcha.
Yes, Kyle.
I guess the other question I'd have is, so we have the two managers, so we can compare them to each other. Is there an inefficiency there? Is there a cost to that? Is there a cost savings and fees from having one manager? Or is it just going to be relatively the same based on there being two separate portfolios?
Tom, you want to answer that?
In my experience, I mean, the size difference, you're probably, you combine them or do them separately. You're probably in the same neighborhood. It's not a meaningful difference in terms of, significance. The two different structures that you also have, are somewhat, I think, important to remember, is that, you have one SEI, which is a full discretionary. You know, the ANCO is a little bit of a different structure. So, but I combining into one consultant, I don't think is a significant savings or cost on the fee issue.
That's so the value of being able to compare them exceeds any cost savings, we could say confidently.
And the board discussed that originally when this process went, initially to figure out one or two consultants. And I if I recall correctly, I think that that consideration, was discussed in detail.
Okay,
Yeah.
thanks.
Julie, go ahead.
Yeah, I mean, SCI might shave off 5 or 10 basis points, to bring on an extra $150 million. That could be the case. I will say this, Tom was kind of mentioning it. The fee structure is different with SCI and ANCO. When we went out for bid on the retiree healthcare trust, when ANCO bid, they bid more of a flat fee rather than basis points like we pay with SCI. So it was originally about $92,000. We're up over 100,000. We had some increases over the year. So right now that is their structure. That is a significant difference than the basis points we pay on the SCI contract. Significant. Like less than half.
Yeah, significantly less.
Hundreds of thousands of dollars. So what you want to do is when you review the performance, like for instance, for SCI in your packet, it's on PDF page 26. You want to review the portfolio return net. That's net of fees. So that's after. In both scenarios, you want, and that's comparing apples to apples more when you look at net of fees. That means it's their performance after we paid their fees, because the SCI fees are significantly more than ANCO's. And that's the middle. When you look at the top, the summary of the performance, there's total portfolio return, total portfolio return net, and then total portfolio index. It's the middle one. That's net of fees. And then I'll send you the page number that the ANCO summary performance is on.
Yes, Tom.
And just for clarification, the SEI is a bundled approach. So that includes investment consulting services, management fees, custodial fees. And so it's a little more all in than the healthcare.
Julie?
Yeah, and the custodial fees are very minor. They're like $5,000 a quarter, so they're very minor. So most of that is the investment consultant fees.
I got one more question when you guys are done talking about that portion.
Yes, Julie.
And I'll just comment, if you were to replace SCI, we would have to probably replace the custodian at the same time, because it's the SCI trust that does the custodian work on the pension trust. Whereas on the retiree healthcare trust, we have ANCO as the advisor, and then a third is the custodian for that trust. So if you were to replace ANCO, we would not necessarily have to replace the custodian that time. But if you were to replace SCI, you would probably want to replace the custodian on the retiree healthcare trust at the same time.
Okay. Brett?
That'd be a silly question, but it popped in my head. We're doing the apples to apples and we're comparing this internal comparison, these two companies together. Is the underperformance of AND company, is any part of that attributable to the fact that not the full amount was invested since inception and they ramped and sort of dollar cost average some of that over a year? Does that take that in consideration, or does it take in consideration only their performance on the portion they had invested at any given time and not that waiting to be invested? Does that make sense?
It makes perfect sense. And I think Julie had mentioned this to me as well Julie, that is correct. You got clarification on that, or do you want to answer that question?
For 2017, yeah, where they stepped it in over a 6 or 8 month period. I can confirm that. I can check on that.
I just want to make sure we're looking at that underperformance and trying to understand that since inception. Obviously, the 1 year and 2 year that doesn't hold, but that since inception number, if that adjusts for the fact that there was a period of time where it wasn't invested, it was just sitting there not earning anything essentially, or in cash, whatever it was.
Mhm.
I mean, Brian's whole thing this entire time, I mean, is waiting for, with Sizer, is waiting for the downturn. So, I mean, I know we've been thinking this is coming for quite some time, but I mean, this, if and when it comes, that's going to be Brian's time to shine, right? I mean, that's been what he's been telling us.
That's right. That there's more downside hedging against the downside risk in the portfolio, and that's when it would sort of step up.
Right?
And we also had a conversation, I think, within the last year or two about what's a fair amount of time to give a manager to really invest the overall strategy. You can't willy-nilly on a year-by-year basis be bouncing around. That's not enough time to let an investment strategy play out and give it a fair assessment. You'd be bouncing around constantly. I think we had asked Brian that question. If I remember correctly, the answer was 4 or 5 years is about the minimum you need to let something run to get a sense of whether it's really working or not working. That was bare minimum. So that probably be considered too.
That's an excellent point. I agree. Does anyone else have anything to add? Questions, comments, concerns? Okay. I think those have been good points of discussion brought up, and hopefully over the next month we can have some more, information presented to us and have a better conversation at the next meeting. So I'm going to make a motion to table any decision until at least the next meeting and put this back on the agenda for next meeting. Is there support?
Brett supports.
Support by Brett. Thank you. All in favor? I am a yes. Brett?
Yes.
Kyle?
Yes.
Paul?
Yes.
And Monica?
Yes.
All right. Thank you.
All right, can I invite Brian back in?
Yes, please.
Duly invited.
While we're waiting for him, I will go ahead and apparently an oversight on my part. I made a motion to receive and file the retiree healthcare investment trust amendments in the last meeting. Instead, I need to make a motion to adopt this document, this policy as amended. So I will make that motion. Is there support?
Brett supports.
Brett supports. Thank you. All in favor? I am a yes. Brett?
Yes.
Kyle?
Yes.
Paul?
Yes.
Monica?
Yes.
All right. Thank you. Brian?
Ready for me?
Yes, sir. I'll turn it over to you.
All right. So we have a couple things to cover today. We have the traditional monthly update, which is nothing but good news. We have an updated draft of the investment policy statement that we're actually requesting board action on. Rather than receive and file, it's actually something that needs to be formally adopted, just for the record. And we also have a recommendation on a new manager to add from a real estate standpoint. And consistent with the investment policy statement, our role was that of a discretionary advisor, so we can hire and fire managers and rebalance the asset allocation as needed. But because we're fans of no surprises, anytime we add a strategy or seek to add a strategy to the portfolio that has some measure of illiquidity, i.e. it can't be completely redeemed in less than a year, we want board approval for that. And that's simply as a courtesy to you to make sure that you have a full and complete understanding of how things are invested and To the extent something's going to be added to the portfolio that can't be exited tomorrow, we want to make sure that you're fully aware of it. So I'm going to start with the February performance update. Let me bring up screen share here. You know, as we've heard on things from a retirement system standpoint, it's really been nothing but good news. You know, as January was flat, February the markets have really taken off, and we've seen things actually rally significantly higher here in the month of March. And what's nice has been not only the fact that returns are well into positive territory, but it's really where those returns have been coming from. And candidly, the performance you're seeing is from areas of the market that didn't participate as heavily in the market rally of last year. So it's things like small cap, it's things like value. You know, from a sector standpoint, it's things like financials and industrials. And you're seeing things like tech trade off a little bit, or consumer staples. So you're seeing a rotation of leadership, which we view not only as healthy, but has also been a great tailwind for your portfolio, because some of those strategies like Sizer and Ancora that have struggled a little bit because they own smaller names, because they have more of a value orientation, those strategies have actually come alive and are actually now significant outperformers on a year-to-date basis. So, you know, positive returns across the board from a calendar year-to-date standpoint, from an equity market standpoint. We have given back a little bit from a fixed income standpoint as we've seen rates rise pretty significantly. It seems pretty hard. It seems hard to be excited about the prospect of buying a 10-year U.S. Treasury today to earn 1.75% approximately. But considering, you know, less than a year ago, it was as low as 0.5. That's a pretty significant increase in interest rates in a very, very short period of time. Cover this chart on a monthly basis. I always think this is really powerful, just talking about the overall success of the system. So the investment portfolio has added just over $38.4 million in value in the almost 4 years it's been in existence, or just shy of an 8% return. So it continues to be a profitable exercise to go through the exercise of issuing those bonds and investing the proceeds into the retiree healthcare plan to help close that funding gap. And the portfolio continues to be very, very successful. So let's talk about performance just briefly here. For the month, gained another 1.77%, puts us in positive territory on a year-to-date basis, up about 1.3%. And as I'd mentioned, that performance really comes from some of the small and mid-cap managers. Sizer, most notably, is up almost 8% year-to-date. If we take that number through today, it's now closer to 15 or 16%. Ancora up about 8.4% on a year-to-date basis. If I fast forward that number today, that again is now looking at a 17 or 18% return. So you've seen a big jump in particularly small cap stocks here in the month of March. One change we did make, and that was detailed in a memo that Lisa sent out earlier this week. So we found an opportunity to trade up from a talent standpoint. So the Vontable Foreign Opportunities Fund has been replaced by the GQG Foreign Opportunities Fund. They're run nearly identical. The lead portfolio manager, Rajiv Jain, that runs GQG, which is a firm based down in Fort Lauderdale, actually ran Vontable's International Equity Fund up until 2016 when he left to find his own firm, left to start his own firm. So we had finalized due diligence and kind of watched that team and compared them back against what's the track record for the Vontable team, and discovered the opportunity here to trade up from a talent standpoint. So that has been a complete swap. So when you see, for example, the March 31st performance report, you're going to see the Goldman Sachs GQG Foreign Opportunities Fund listed here in place of the Vontable Fund. So that's us just continually looking through for new opportunities and higher conviction strategies to make sure that we've got the portfolio positioned as well as possible. From a fixed income standpoint, as we mentioned, just talking about market commentary, gave back a little bit. We do have the fixed income portfolio positioned a little bit more defensively here, just with a view that with rates being so low, you weren't getting paid to take on a whole lot of risk. So that's where we're in a little bit, I'll throw out the term shorter duration, but just, you know, in bonds that might mature in the next 5 to 7 years rather than in 10 plus, just a little bit less sensitivity to interest rate movements. And that's where Baird's held in pretty well, only down about 1% for the year. And Loomis, a little bit more aggressive fixed income portfolio, a little bit more opportunistic. Recall, this is a replacement as we'd eliminated the dedicated high yield allocation because we just felt we weren't being compensated for those risks. Again, in line with the market on a year-to-date basis, down about 1%. But since that was added back in November, it's actually held in and done quite well. And then finally, real estate. No news here just because this price is on a quarterly basis. We do have a bit to talk about with real estate later on in the agenda. But from a performance standpoint, really nothing but good news. And we've been very pleased to see some of those managers that have struggled a bit really start to turn on from a performance standpoint. And you're seeing some significant outperformance so far this year out of the likes of the Sizer portfolio and the Ancora portfolio. So with that, I'll pause and see if there are any questions related to performance or capital markets.
Is it, so we were, talking about the two different, fee structures and such. Is it, when you're making presentations to us, is it net of fees?
So you will see, I'll bring up the report. There's going to be two lines on the report. So the top line here references gross fees, and second or third line down here, total fund net of fees, is going to be net of our fee. And to be honest, the only difference here between the two, everything ends up being net. We always show a gross number and a net number just so you can see the difference. But because the expenses are carried out of the underlying portfolios, all of the numbers that you see on this page are net of fees.
Okay. Perfect. Thank you. Does anyone else have any questions for Brian?
All right, so next piece. So we had walked through investment policy statement at the last meeting, and really the purpose here is this is not substantive changes to the document. This is just cleaning up a little bit from a kind of a best practice language standpoint, as well as clarifying from our end where things are positioned from an asset allocation standpoint, as we have the option to fund some alternative investments. And really where the change is where we sit here from a target allocation standpoint. So there's two tables. We've added a second table to the investment policy statement labeled transitional target allocations. And the primary difference here is you will see a line here labeled other assets. So there's a 10% target to other assets, and that's going to be things like private equity and private debt that haven't been funded because the returns and performance that we've seen out of the equity markets haven't necessarily warranted increasing exposure to those parts of the market. That's a project we're going to undertake around this table over the coming meetings, just looking at education and discussion around some of these different strategies and the pros and cons associated. So because those aren't funded yet, while the investment policy statement had language that referenced, if assets aren't funded to these other assets, it's going to be rolled back into other parts of the asset allocation. I'm a big fan of just making sure that it's completely clear, particularly for, a new member to the board or an outside auditor looking at this to say, okay, if you've got zero in these asset classes, where's the money invested and what's the minimum and maximum allocation? So that's where I've added a table that's transitional target allocations. And you'll see here, other assets, the target is labeled as 0. And what we've done is had a slight increase in core fixed income from 15 to 20, a slight increase in domestic equity from 45 to 49%, and then a 1% allocation to cash just because of the ongoing cash flow needs of the trust. This target allocation that you see right here is where things are invested currently. So this isn't a change in terms of investment strategy. It's memorializing where we are currently positioned, and we're comfortable with where we're currently positioned, and allows for a new reader or an outside reader to view this document and say, okay, you haven't implemented any other assets yet in private equity or private real estate, in private equity or private debt, or commodities or whatever it may be. So I'm going to go to this transitional table and say, are you in compliance with the investment policy statement? And the answer is yes. Okay, great. I have no concerns here, and we can move on. So this is identical to what was presented at the last meeting. The difference is, and I'll apologize, I should have caught this. This document isn't a receive and file. This document should be something that's approved by the board.
Okay, thank you. Actually, while we were waiting for you to join, because it was a housekeeping item that we had already covered in the last meeting, we did go ahead and adopt that already.
Okay, perfect. All right, moving on. So the next piece we wanted to talk about here is, and looking at things from an asset allocation standpoint, is we think now is an opportune time, just given what's going on from a real estate standpoint and the opportunities that present itself, is we want to add an allocation to what we refer to as value add real estate. So the exposure we have currently to real estate is with the PRESA 2 fund, which is Prudential Real Estate, and it's deemed to be a core plus fund. So it's a combination of core properties. So think high quality Class A, office buildings, apartment buildings, industrial centers, retail strip malls. So really, really high quality buildings that are very well leased and in really, really good market environments, right? So this is not a handyman special. These are properties that are true Class A properties. So that represents about 76% of the portfolio. The balance, or about 24% of the portfolio, is in non-core properties. These can be, apartment buildings that need renovation and lease-up activities. One of the major projects that they're going through is converting on the East Coast, a bare acreage or vacant acreage into an industrial distribution facility. The idea of e-commerce and everything else, it touches something like 60% of the population in less than 24 hours. So those are the types of projects you're going to see on the non-core side of things. If I use, Royal Oak as an example, the non-core development here, the idea there is it's the builders that we see around town that are taking a 1,000 square foot bungalow, scraping the first floor, leaving the foundation in place and building a 2-story colonial on top of it. So that's, development risk. They're not necessarily doing that project to generate income. They're doing that project to generate market appreciation. That's a non-core piece versus someone, buying a bungalow near, say, Beaumont for a rental unit. That property is going to be more likely to be an income generating property rather than a market appreciation generating property. That's going to be more of a core considered holding. So where are we positioned currently? I always think this is an interesting exercise. So this is really a breakdown as of year end of the PRESA portfolio. So we have about a third of our real estate exposure on the West Coast, about 40% on the East Coast, 24% in the South, and a small amount in the Midwest. A lot of this is going to be in kind of the Chicago market. There isn't anything here in Michigan. About an equal split, about a third each between office and multifamily, and then about 18% in retail, and then you'll see self-storage, land, and industrial. This land represents that project that I'd referenced earlier that will eventually become an industrial development. So that industrial underweight is going to significantly change. So if you look from an exposure standpoint versus kind of the broad institutional U.S. real estate market, we're a little underweight West Coast. We're a little underweight Midwest. We've got a heavy overweight or a healthy overweight to the East Coast. From a property type standpoint, underweight industrial, and this is shifting. Biggest overweight is in multifamily and in retail, although the retail overweight may give you pause, but I will tell you a lot of the exposure that PRESA has is in grocery anchored strip malls. There are no true suburban malls in the portfolio. That would be the type of thing that would give us pause. So as we look, there's some opportunity here. We've got a really well diversified, really high quality portfolio, but we're recommending that we add an allocation to a value add fund that has a focus on growth markets. So rather than necessarily worrying about maintaining a broadly diversified portfolio and buying properties on the East Coast and on the West Coast and in key markets in the South, the TerraCap portfolio that we're recommending being added, their primary focus is on identifying markets that have consistent population growth. The idea being, when you talk about markets like Denver, Phoenix, different markets in Florida, Atlanta, Charlotte, Raleigh, these are cities that are moving from being 18-hour cities to being 24-hour cities. They are net gainers on a year-by-year basis from a population standpoint. So if there's population growth, that's a good driver from a demand standpoint for things like multifamily, or believe it or not, things like office space and industrial space, because you have businesses moving into those markets that are drawing the jobs in. So this would fall in the real estate bucket. To give you an idea from a current asset allocation standpoint, so we are about 2.5% underweight our target. As we updated these values through today, this shows we're about $3.6 million underweight. We're actually about $4 million underweight. We just think this is a great addition because it's focusing on markets where we have less exposure and focusing on property types where we think from a demand standpoint, you're going to continue to see opportunity. So we've included a lot here from a foundational standpoint. And in the later pages, there's a lot from a profile information. But where we think TerraCap shines compared to others is, the goal of increasing this real estate allocation is not only getting it to target, but it's also decreasing some of the exposure we need to have from a traditional equity standpoint. So we're trying to find and add to strategies that aren't dependent on the market going up tomorrow to generate a return for investors, right? So it's investment managers and strategies that can use their talent and their expertise to identify opportunities in real estate, in this specific example, to generate a strong return for participants. And in TerraCap's case, one of the hallmarks, not only have they had a great track record, this is Fund 5 and Funds 1 through 4 have all been very, very successful. Same team, if not better, that's managed each of those strategies. One of the hallmarks is they are quick to deploy capital. So one of the frustrations investors can have when they allocate to new funds like this is, great, I'm excited about it. I've committed $4 million and it takes 3 years for the money to go to work. So while we wait over those 3 years, that money is invested in other parts of the portfolio, but I think there's an opportunity now in these markets. I want to take advantage of it now. I don't want to wait 3 years to see my money put to work. TerraCap has consistently been one that puts the money to work in 12 months or less. And we've seen it actually be in a shorter time frame than that. So we'd expect to see this money deployed in a pretty rapid pace over the course of this year, maybe a little bit into next year. But as we view it, it's a great way to take some profits off the table that we've had from an equity market standpoint and redeploy it into other parts of the investment landscape that we think should be able to generate some good returns in the years ahead. So that's it in a nutshell. I just want to pause and see comments and questions.
So, does that, we've been preparing for the downturn, right? So, how will that be affected on the downside and with interest rates? What is it? Does that go along with the same thought process that you've been following in the past, or is this a different direction?
So this is going to be something that's truly different. If we see an absolute, day of reckoning, big correction of the markets, so think what we saw last year, only longer and more protracted. So more like a 2008, 2009 type of pullback. There's some fundamental issues going on with the market from a health standpoint. There's way too much leverage out there. The system is just generally unhealthy. This strategy and frankly, anything but high quality fixed income is going to fare poorly. We don't see that now. Yes, markets are at all-time highs. Interest rates have come off of record lows. But there's still a lot there to kind of push things along from a return standpoint. One of the keys for this specific strategy is, and this is something that we've identified in our due diligence, is TerraCap's success isn't predicated upon, I found a building that I can buy for cheap, I put a bunch of money into renovating it, and then I sold it to somebody else. Part of their strategy is they fall under the radar of a lot of the larger institutional funds. They're looking at properties that sell for, say, $10 to $30 million. So these big multi-billion-dollar funds that are out there just flat out aren't going to transact in the space. And what's kind of labeled as the country club investment window, it falls below that. So it's in a bit of a gray area in terms of there aren't a lot of individual high net worth people going after these deals. And the really big funds that are out there aren't going to traffic in this space because they're too small. So a lot of what they find is, and it's a bit of a morbid example, but dad owned 3 apartment buildings in Atlanta that was maybe 300 units, between the 3 of them. Hasn't been remodeled in 10 years, haven't changed management in 20 years. It's just a tired property. Dad passed away and there's 3 kids. 3 kids they live around the country. They don't want to manage the property. They don't want to go through that headache. They want to sell it as a part of the estate. This is where TerraCap, through their network of brokers around the country, they get a call. And they have a demonstrated talent of taking actually good properties that are just poorly managed. So there isn't a big lift. We got to go in and do, paint and a little bit of work from a marketing standpoint, maybe bring in a different management unit. So they're able to more quickly generate rent growth and make that property attractive for a core investor. So it's less impacted by the markets and more impacted by, can we get in and do what we need to do and turn this property around and make it more attractive to the next buyer? So this is really kind of completing the real estate allocation. I'm comfortable with where things are positioned from an equity standpoint. We're a little bit more defensive, and that's because we're 94% funded. So if we see another pullback in the equity markets, it's going to be a bigger hit to the retiree healthcare plan because of the funded status, right? If you're 100% funded versus being 50% funded, every 10% move in the equity markets is a 10% hit to your funded ratio. But if you're only 50% funded, every 10% move in the markets is only a 5% hit to your funded ratio. So you move around a lot more. That's the curse of being better funded. So that's where, there's a little bit more, I'll call it focus/paranoia of negative markets, just given the health of the system.
Okay.
I got a question. I'm prepared to articulate this correctly, but let me think how to ask it. Maybe I don't understand exactly what type of real estate they're looking at getting into. You've explained it a couple times, but what concerns me is how quickly things are changing as far as consumer behavior, how people choose to live, where people choose to live. How much of this strategy only succeeds if we guess that right over the next 5 years? Things are changing so rapidly that, I don't know, real estate seems like kind of a either get it right or get it wrong. And how much of this, what they're going to invest in, depends on them guessing correctly what the world's going to look like 4 years from now.
I'm going to say maybe 20%. So the vast majority of their success is going to be driven by, I'll give an example. I would expect a lot of the projects you see in this to be multifamily oriented. So apartments and condos. So one of the things you're seeing coming out of COVID is, let's talk about things that are likely to change, right? My need for more space at home. If I'm going to work from home, then I'm going to need a little bit of different setup in terms of, if this is going to be a permanent piece, then I can't have a folding table in the corner of my bedroom, right? I need dedicated workspace to be able to handle this. You're also seeing some significant shifts from a population standpoint. New York is not the place it once was. Goldman announced yesterday. Credit Suisse announced a couple of days ago. You're seeing people moving out of New York and into Florida, Texas, North Carolina. So that's where TerraCap's success and where they're focused is on those markets that are gaining new people. And if they're gaining new people, that's a good tailwind for real estate, regardless of what's going on from I don't know if societal change is the right word, but regardless of what's going on from a COVID change, right? So specific to your question, we don't know what it's going to be like in 3 or 4
years. I'm going to interrupt you, but there's a lot more than just a COVID change. You got the potential for policy changes with drives to make home ownership more accessible for people, which could make multifamily less profitable. It just seems like so many things are up in the air with the world, not just with COVID and the pandemic, but with politics and policy and everything. That it just seems like there's so much potential to guess that wrong, you know, versus other strategies. I'll be honest, the real estate thing concerns me. So,
Brian, could you refresh my memory? What percentage of the fund are we talking about here?
2.5%. So we have a 10% target to real estate. 7.5 of that 10 is currently in the PRESA 2 real estate fund. So we're talking about here would be an addition, so a new allocation of $4 million that would fill the rest of that bucket.
Okay. I definitely understand your concerns, Brett. We did ask for diversity. I mean, we did kind of ask for this, and I don't know. Yes, Kyle.
that was also before the world got flipped upside down. I mean, there's things happening now you never would have imagined would have happened even a year ago. So I'm just wanting to reevaluate, that and going forward. I don't know, the hairs on my arms are kind of standing up talking about it, to be honest with you.
Yeah. Kyle.
Yeah, I'm not sure that uncertainty applies. I mean, I appreciate, where Brett's coming from, but I'm not sure it applies in any specific way to real estate. I think diversity is what keeps us safe. And I feel like in many ways, real estate is over time a surer investment, because you're right, policy can impact it to some extent, but it is a finite resource that there is not going to be more of. And with rising sea levels, there's probably, going to be less of it over time. So unlike some other things, I feel a bit more secure in real estate as a kind of tangible asset.
And I agree with you. And there's areas I drive around on surveillance that have plenty of real estate nobody's interested in. So that's where it's important to get. I guess someone's got to be guessing that right. Where are people going to want to be, and how are they going to be spending their money? How are businesses going to be set up? The Amazon warehouses sound like a good investment right now. I don't know. I'm sure these guys spend a lot more time thinking about it than me, and they know a lot more about it than I do. Just my gut starts to be like, oh boy. Things seem very uncertain right now. It seems like kind of a guessing.
I feel that. I feel like with the whole GameStop thing, it all seems like voodoo to some extent, but
yeah,
at least real estate is something I understand.
Yeah, and I don't. So I'm just bringing my gut feelings into it for discussion purposes. I'm not expressing a hard opinion on anything. I'm just sort of let's get some discussion going. So.
No, I appreciate it, Brett. You always have a good insight, so that's welcomed. Absolutely. Julie, did you have something to add?
Yeah, just a question for Brian. Under the alternative category, has there been any consideration bringing anything forward in the farming realm to the board?
So that's something we've talked about, and this is where I think you have a little bit more inside baseball on it, just with your work on MMRMA. We've had some clients that have had farmland exposure in the past, and it's been a zero. It's been a positive return, but I don't think it's been as strong from an expectation standpoint. It's in the works. It's something we're talking about, but it isn't something that we've actively invested in at any point in the last 10 years from a client standpoint. It hits a little bit more closer to home from my standpoint, because my family's got, I have a family farm back home. So we've seen a lot of that impact just in terms of some of the pricing as people have come in, but it isn't something that has historically been a part of client portfolios.
No, not historically, but as Brett was talking about, we're moving forward, and, the discussion on concerns when it comes to farming and food sources and things in the future, would that be something to look at now? Forget about recent past history, just looking forward in farming is just my question.
Yeah, I think it would definitely be something for consideration. That's a little bit of a longer life cycle from an investment standpoint than you see out of what I think of as what I'll label as traditional real estate, the pieces that we have currently and what we're talking about here with TerraCap. But it's certainly something that I'm open for a bit more research and a bit more discussion over the coming months.
Does anyone else have anything for Brian? Yes, Monica.
I understand that you said that multifamily, the bulk of this is surrounded or looking at the multifamily unit. How much does commercial real estate play into it? Because like Brett, I understand, their concern, at least with real estate at this point, particularly with commercial property as people are starting to work from home more permanently. But I know this is a small chunk of the portfolio, and typically real estate is a very solid investment. But for my own edification, how much is commercial playing into this?
So let me bring up one piece here for you really quick. So it's, I think, an important distinction. So everything we talk about from a real estate standpoint around the table when we're talking about real estate from an investment standpoint, I've used an example of single family homes in Royal Oak just to kind of show the difference between core and value add, or the idea of, a more conservative return assumption versus more aggressive. But when we're talking about institutional real estate, we're talking about commercial real estate, which is four main property types: office, multifamily, which is predominantly apartments, industrial buildings. So think, Amazon distribution warehouses, and then retail. Those are the four main property types. Some managers will have some exposure to specialty property types or more niche, and that's going to be things like hotels, self-storage, senior and student housing, medical offices, single-family rentals. That was one thing that came out of the 2008-2009 downturn, is you saw some really, really big funds come in, and they would come in and buy an entire development. So 500 homes are going in here. We're going to buy this entire 500 unit development, and we're going to turn it into a rental piece. None of that is TerraCap. TerraCap's going to be predominantly multifamily and some office exposure. So nothing from a single family housing standpoint. From our standpoint, I've always kind of viewed it, residential housing, residential real estate, the city, the township, the county, whoever we work with, like, they bear enough risk from a property tax standpoint on the health of the residential housing market that it isn't something that's traditionally included in an institutional portfolio. That's going to be more of the commercial property types instead of single family housing.
Okay, and when I said commercial, I probably should have said office space, but I think I understand from your
explanation. Yep. Yeah, no, it's an important distinction, because we throw around institutional real estate and commercial real estate a little too often, and it's important. I appreciate the question.
Sounds good. Thank you. Does anyone else have anything for Brian? I mean, I know it could be viewed as risky or uncertain, but I do strongly feel that this is exactly what we have asked of Brian, and I appreciate it. I think I like it myself. So. Are you looking for a blessing on this? You want a motion to move forward?
So yeah, that's exactly it. And right, this comes from a I hate surprises standpoint, right? So this is, I want to make sure everybody understands this. This is an illiquid investment. So what we're asking the board to do is approve a commitment of $4 million to TerraCap Fund 5. That money's, so that's a maximum amount that can be invested. So they're going to call that money down in increments over time, say over the next 12 months, invested into a variety of underlying properties. And then as they sell those underlying properties, they're going to distribute the funds back to us. So it's adding a measure of illiquidity to the portfolio. And we were deliberate when we wrote language in the investment policy statement that said we can add any strategy as long as we can get out in less than 12 months, right? But if we're going to add anything that's illiquid, we want to make sure the board fully understands the liquidity provisions of the strategy before we move forward with it. But put in context, 90% of our assets can be sold today, right? We can turn 90% of this portfolio into cash on Monday. 7.5% of it's liquid on a quarterly basis. So this would be 2.5% that would be illiquid. That really doesn't have it's got an exit opportunity. You'd have to sell it to somebody else. But again, it's different. It can't be sold tomorrow. We want to make sure you're aware of it.
Do we have other things in the portfolio that we're locked into it for a certain amount of time? You said 90%.
So 90% of it is liquid on a daily basis. 7.5%, that's the Prisa 2 exposure. That's able to be liquidated on a quarterly basis. It's really, as it is right now, 92.5% is liquid on a daily basis, 7.5% on a quarterly basis. After this, it would be 90% daily, 7.5% quarterly, and 2.5% would be effectively illiquid.
Okay. So now that I know those details, don't take this the wrong way, Brian, but I'm going to make a motion to table this decision until after we have completed the consultant review, which was tabled until the next meeting. So,
okay.
I hope you understand.
Yeah, totally.
Okay, I'm going to make that motion. Is there support?
Brett supports.
Support by Brett. Thank you. All in favor? I am a yes. Brett?
Yes.
Kyle?
Yes.
Paul?
Yes.
Monica?
Yes.
All right, thank you. Did you have anything else, Brian?
That's it from my end.
Okay. Thank you. That brings us to, I'm gonna make a motion to receive and file everything that was provided by Brian. Is there support? Support by Brett. Thank you. All in favor? I am a yes. Brett? Got a volume issue there, Brett, but Brett is a yes. Kyle?
Yes.
Paul?
Yes.
And Monica?
Yes.
Okay. Thank you. Thanks again, Brian. I'm now going to turn it over to Tom for legal.
No formal legal report. Just be well, everybody, and looking forward to some sunshine. Thank you.
Sam, thank you. Brings us to other, which we already have covered the consultant review. Julie, did you want to briefly re-mention the trustee election?
No, that's all right, unless someone has some questions.
Okay. All right, just in case someone is watching this meeting and not the first one, it was the Retirement Healthcare Investment Board trustee election of 2021, which will be distributed on April 9th, 2021 to the police station and fire stations. And it will also be included on the NOD. Date of the next meeting has been set for Friday, April 16th at approximately 8:30 a.m. or immediately following the pension board meeting. That said, I'm going to go ahead and make a motion to adjourn. Is there support?
Brett supports.
Support by Brett. Thank you. All in favor? I am a yes. Brett?
Yes.
Kyle?
Yes.
Paul?
Yes.
Monica?
Yes.
All right. Meeting is adjourned at 9:20 a.m. Thank you very much, everyone. Have a good month.
Thanks all. Take care.
You too.
See you.